everyone. So DSP released its quarterly update called the Navigator just in the last week. What is Navigator? Navigator is a report which tries to understand the drivers of returns, which are earnings, valuation, macros and flows, and the interest rate environment. And every quarter it gives an update on where we are in this cycle. Eventually, it also tries to give an ideal asset allocation for the current market environment and the current drivers of returns, and helps one to build their portfolios using DSP funds. In this video, we will run through some snippets of the Navigator, but I strongly urge you to read the full report. So what are we essentially trying to say? Okay, so in the last Navigator, we said that at markets between 16,500 to 17,000, we should add more to large caps and take up the equity allocation. We'd be very honest, the run in markets to the current levels have been much faster than we had previously expected. And therefore, this time we say that even though large caps do not look cheap anywhere, there is more opportunity in the small and mid cap, and therefore equity allocation should be kept at 50%, but there should be more of this should be allocated to small and mid caps. Secondly, we are ending 2022. The worries of 2022 were very different from what lies ahead of us. So I think it's a good time to say bye to worries of 2022, such as inflation, hawkish monetary policy, supply squeezes. Instead, 2023 will bring different worries. I would worry about growth. I think markets will worry about growth and probably also reward it more. Third, the sectors we recommended in the last Navigator, banking, automobiles, pharmaceuticals, and healthcare, have done well, and we continue to stay with them. But additionally, we are scouting more opportunities in stories benefiting from rural recovery, so fertilizers, etc., realty, defense, and some consumer durables. And finally, on the fixed income front, we think adding risk-adjusted duration makes sense. Now, the final word, we feel we are in a multi-year bull market with intermittent pullbacks and corrections. Asset allocation can help smoothen this journey, and therefore we suggest building a good mix of equity and debt in one's portfolio. So let's start with the first driver of return, which is the valuation, where we say that there is more opportunity in the small and mid cap space. Nifty valuations at close to 22 now are very close to their long-term averages. They're not really cheap. But if we look at small and mid caps valuations, they're still below their long-term averages. A lot of froth is removed from mid and small cap since they have underperformed the large caps for some time now. Additionally, if we were to look at small and mid cap market capitalization as a percentage of overall market capitalization, in the last peak, the number was close to some 29%. In the peak before, it was some close to 30%. We are still at 25, 26 kind of a level. So there is more space there. When the real economy starts to recover, okay, so when the growth cycle has strength, it is the small and medium caps companies that do well. We think that India's growth is poised to be robust. We may be clocking 6.8% this year. But incrementally, there is strength in the domestic economy, and therefore the effects of growth will trickle down to small and medium cap. In terms of earnings, we've just finished the September quarter earnings. There's one key trend which we highlighted last quarter as well, that margins are contracting. Okay, so the PAT growth for the NSE 500 universe has been close to 7%. But there has been a significant contraction in the margin, and there has been a good growth in the revenue. Okay, so why is this happening? Because raw material prices have gone up significantly. We want to reiterate our view that we wrote in July last year, that the inflation will collapse. So the input cost pressure that companies are facing will ease, and that should reflect in lower margin contractions going forward, and therefore better earnings for Indian equities. Also, if we look at sectoral earnings, it is the sectors that we like that have given good earnings. So we are finding earnings-driven valuation comfort in these sectors. So let's say consumer discretionary, trailing 12 months, September 22 growth could be close to 19%. Similarly, financials were in pink of health, growing at 33% in their earnings. So it's not just the price action, the macro story, but also a solid earnings stories that is backing these sectors. Overall, in the Indian markets, the quality parameters are very pleasing. Return to equity is above pre-COVID levels. FY19 number was 13%. Today, we are at 14%. Similarly, net debt to equity, we are as equal to what we were pre-COVID, essentially saying that the quality parameters are pleasing, and it points to long-term growth potential in the Indian equity market. Now, the third driver of return, we've done earnings, we've done valuations. We move to the third driver, which is macros and flows. We've heard a lot about the global slowdown. It is true and visible in the data that the global PMI has started to contract. The Indian PMI, however, continues to expand. So definitely the domestic resilience in a global slowdown, a steady ship in choppy waters, that's all true. In terms of what's slowing down globally, there is more slowdown in manufacturing in US than it is services. So this is reflected on our exports as well. Our manufacturing exports, let's say engineering goods, are down about $4 billion month-on-month basis. But our services exports at 12 billion a month are clocking another high. So for now, while there is a slowdown in the rest of the world, most of it is limited to manufacturing, but the spillovers to services may come in the late cycle. Also, we spoke a lot about shape of the recovery while we were in the pandemic. I remember listening to you being K. I think it is the K that is actually playing out. If we were to look at rural wages, the real rural wages versus the real urban wages, rural wages are still negative. Whereas the urban wages are have given a very, very healthy growth after the pandemic. So the trickle down of the top layer has not yet happened. Similarly, if we were to see the NSE 500, the listed space EBITDA versus the gross value added in the overall economy, sequentially, quarter on quarter, GVA has dwindled down, but the NSE 500 EBITDA has gone up. So the clear K formation is what we are seeing in the data as well, where the unorganized is not doing well, the organized is doing well, the rural is yet to do well, but the urban has done well. So the K shape of recovery is where we are at, but we think that the trickle down eventually will happen. Saying bye-bye to 2022 worries, I think between June and October, which is like 3 months period, we've seen inflation come down in all major economies. June inflation has been lower than October inflation. So clearly, momentum has turned. The lead indicators that we are tracking in terms of commodity prices, oil futures, all point at a lower inflation ahead. And therefore, the rate hikes and monetary policy hawkishness, which was a clear worry of 2022, is unlikely to pass through 2023. But that's not to say that 2023 will not bring different worries. I think watching growth in 2023 will be very important. So summing up the macros environment, we think inflation, very high inflationary regime and hawkish monetary policies are now behind us. It's a K-shaped recovery, and therefore trickle down should happen. And finally, India is turning out to be a steady ship in choppy waters. Now, the last angle of India's macro, the fiscal, and we have a budget coming up in February, just 2 months from now. We think the fiscal fear is overblown. number one, when the budget was made in last February, nominal GDP growth was expected at 11%. This year, inflation has been so huge that we think we will overshoot this number by 3% at least, which means that headline fiscal deficit could be curbed because nominal GDP in itself will be bigger than was budgeted. Secondly, tax revenues, of course, have been strong. There is a clear increase in corporate tax, income tax, etc., but certain other aspects of revenue, such as excise duties and customs, have seen a bit of a downfall. But overall, strong tax revenues. There has been some increase in expenditure, which will the increase in revenues will make up for it. And finally, the nominal GDP will be much higher than was budgeted. Overall, we think the fiscal fear is overblown. Government is likely to meet the headline numbers when we see the Feb numbers in another 2 months from now. Now, the big question always, where are the FII flows? FII flows have come to India in November. We've seen 4.4 billion in net inflows, but 2022 has been bad. We're sitting at a net equity outflows of about 18 billion, which is historically one of the biggest YTD outflows till date. But I think that the tide has turned, and we expect FII flows to come to India. We expect that the dollar index will weaken, and FIIs will be attracted to emerging markets. And within emerging markets, India is a very good place to be. And therefore, flows will come to India. Again, flows have come of the 4.4 billion we've gotten in November 22. It's there in finance, auto, healthcare, industrial. So the flows are also aligned to the earnings, macros, and fundamentals that we are watching. A lot of time we get asked, can India sustain a premium over the emerging markets? I think the premium in the market has been a function of the premium in the economy. India and EM GDP growth differential has been about 3.6% for this year. And therefore, it is the Indian markets that has outperformed the emerging market basket. And it is the Indian markets which have also gotten flows of late. Finally, the fourth pillar of the drivers of return. So we've spoken of valuations, earnings, macros, and flow, and now we go to the fourth pillar, which is the interest rates. We think that interest rates hike is not a significant worry anymore, and the ongoing narrative could be that global liquidity is slowing so fast. But if we look at a 3-year CAGR, it's still growing at a healthy 9%. So we are not aligned to a fully risk-off sentiment. We think if we adjust for the base, etc., global liquidity growing at 9% is a decent, healthy number. Similarly, when we look at India's liquidity, India has had a drought of liquidity deficit from 09 to 016, and we've been a country which is in a liquidity deficit regime. Now we are in a surplus, and despite the RBI sounding hawkish, despite the rate hikes, we do maintain a surplus liquidity. So we think that India's liquidity tightening is not as bad as past cycles. The hawkishness, is probably behind us than ahead of us. Most monetary policies will take a pause stance in this meeting or the one after. So now we've covered all four. We've talked about valuations, where we've said that large cap valuations are not cheap. More opportunities there in small and medium caps. We've talked about earnings, where we've shown that there is a margin contraction, and that should reverse. But the sectors that we like have also delivered good earnings. We've talked about macros and flows. We've talked, considered India's K-shaped recovery, the fiscal fear that is overblown, and India's domestic strength amidst global slowdown. and that India has gotten more flows than its EM peers because it has also had stronger growth. And so this covers, and finally, we talked about interest rates, where we said that the hawkishness of monetary policy is now behind us and not ahead of us. And therefore, interest rates are not something to worry too much about in 2023. Now, linking these macro trends to some of the sectors we like, we've been talking of healthcare strength for a while. So we think, US generics is picking up, India businesses are stabilizing, and therefore a mix of US and Indian businesses in a portfolio would make sense. Reality sector, we think, is now staging for a comeback. Defense, again, one of the emerging themes. We've been investing into these themes, but with indigenous expenditure increasing, and India's defense has expanded at a 3-year CAGR of 13.3%. However, as a percentage of GDP, it is far lower than many other countries. So therefore, we see a huge potential in the defense space as well. And consumption indicators have done well. So there could be some contraction in these numbers as we go forward, as the festive season euphoria fades away. But for now, consumption indicators seems to be doing historically well, and we all felt it in the festive season in October, November, something that was being celebrated properly after 3 years. So a lot of spend has been done on consumer durables, and therefore, consumer sentiment, retail payments, personal loans, all of these numbers are looking very, very healthy. Global tech, I think there's light at the end of the tunnel. If we were to look tech sectors, underperformance as a percentage of S&P 500, 2022, they have underperformed the most since 2002. So I think that removes most of the froth from global tech. If we were to look at NASDAQ valuations, etc., they are very close to their long-term averages. So there is some opportunity in global tech, and with inflation easing, that which has been our base case throughout, global tech also becomes the sectors to look at. So let's just quickly sum it up. Equity, as we said, we continue to hold banking, financials, healthcare, pharma, some construction materials, but we are also looking at fresh opportunities in sectors benefiting from rural recovery, reality, defense, and some consumer durables. In terms of fixed income, I think the idea has been to be ahead of the curve. Some risk-adjusted duration we are adding into our portfolio, but we think Q4 of this year would be a better time to increase duration at once. Commodities, we think China reopening is an important turning point for global growth, but our expectation is that gradual reopening of China will not only improve demand, but will also improve supplies coming out of China. And therefore, overall, it could be a non-event for global commodities. We expect commodity prices instead to give policymakers more reason to tone down their hawkish stance in 2023. Very low commodity prices leads to a global slowdown as well. And we think that is the kind of picture we're going to see in 23. Materially, there is no lead indicator that is pointing to an uptick in commodity cycles as we speak today. Now, how to position your portfolio? We think for a moderate risk appetite, we would continue with a 50% allocation to equity. And there are certain model portfolios that we've given out that can be built using these strategies. I think that's it from the DSP Navigator report. I would strongly urge you to read the full report. Thank you for listening in. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.